Company Limited. I am Aryan Rana, your host for the session, and it brings me great joy to guide you through the proceedings as we analyze the financial results for the third quarter, concluding on December 31st, 2023. While the detailed presentation and financial results are available on our company website and the stock exchanges, it is essential to note that our discussion may include forward-looking statements contingent upon known and unforeseen risks, uncertainties, and various factors. To offer a comprehensive overview of our Q3FY24 financial performance and address any queries you may have, we are honored to have esteemed members of our management team present today. Ms. Neerja Kapoor, Chairman and Managing Director; Mr. Titus Francis, General Manager, Director and Chief Financial Officer; Mr. Sarath Ramnarayan, Actuary. Without further delay, now I hand over the call to Ms. Neerja Kapoor, our Chairman and Managing Director of ACL, to address the analysts present here on the call. Over to you, ma'am. Thank you.
Thank you, Arya, and very good evening to all. I am Neerja Kapoor, Chairman and Managing Director of New India Insurance, and along with me, as mentioned by Arya, Mr. Titus Francis, GM and Director, and also the CFO. Along with me are also General Manager Ms. Sridevi, who is in charge of motor, and Mr. Sarath Ramnarayan, our appointed actuary. I would like to firstly thank all the participants who have taken time out for attending this con call. To begin with, I shall give a brief background and Mr. Titus shall highlight the financials of 9 months ending 31st December 23. Thereafter, we shall proceed to the question and answer session, wherein we shall endeavour to answer all your queries and clarify any doubts you might have. As you all know, New India Insurance was founded by Sir Dorab Tata in 1919. The company's operations span across 25 countries, and we have been a market leader since the time of nationalization way back in 1973. New India continues to be rated AAA by CRISIL, and India National Scale Rating of AAA.IN Exceptional by AM Best. The company continues to be identified as domestic systemically important insurer, that's DSII, by IRDA. We are certified as ISO 27001.2013 compliant on IT security, thus making us one among the few general insurers following highest standards on data security in India. As you know, the Indian general insurance industry has been growing impressively. And for the period ending 31st December 23, the industry has grown by 14.02% and has completed a gross direct premium of rupees 2,13,486 crores. And as per current trends, it is expected to cross 2,90,000 crores by the end of this financial year. For New India, the Indian gross direct premium grew by 9.04%. And as I have mentioned in the past, our motto remains growth with profitability. And in this process, we have let go of a few loss-making businesses which were unwilling to renew at the right price or terms. While the direct premium growth has been lower, the gross written premium witnessed a growth of 15.38% in the third quarter, and 10.5% for the 9-month period as the company wrote crop business of 258 crores as inward reinsurance from our sister company AIC during the quarter. Our market share is 13.33% and we remain the market leader. The industry continues to be highly competitive. The combined ratio of the industry, which we usually get with a 1-quarter lag, for the period up to September 23 was 112%. For New India, we reported a combined ratio of 120.64% for the 9 months ending December 23 and 116.56% for the quarter ending December 23. In the third quarter, the country has witnessed catastrophic events like Cyclone Migjong and floods in South India, Sikkim and West Bengal. The net impact of these events on the company's third quarter results was about 358 crores, which is in addition to the 301 crores of catastrophic claims that adversely impacted the results in the first half. The impact of CAT losses on the ICR was about 2.9% for the 9-month period and 4.4% for the quarter. Despite this, the profit after tax for the 9-month period was 775 crores, as against 900 crores for the corresponding period last year. Balance sheet remains strong with the net worth at 20,754 crores and the investment assets stand at rupees 94,512 crores. The investment environment has been buoyant and the company's net worth, including the fair value change account, increased from 37,957 crores in March 23 to 44,690 crores in December 23. Solvency ratio remains comfortably above the threshold of 1.5 times and we are currently at 1.72 times. The company has a well-diversified portfolio of products, including the recent launches of surety bonds. In fact, New India is one of the few insurers issuing both big bonds as well as performance bonds, and these policies will go a long way in supporting the infrastructure growth in the country. We have also come out with modern treatment rider under the health insurance policies, the Battery Protect add-on for electric vehicles under our motor line of business, along with the pay-as-you-drive policies which we had launched earlier. My Cyber policy to address the cyber threat for our retail customers, Criti Protect policy to provide protection in event of critical illnesses, and earlier, of course, the drone insurance policy has been launched. We are continuously endeavoring to provide the best of customer initiatives and service. Going forward, our focus remains on digital initiatives, streamlining processes for increased efficiency and increasing our sales force with a focus on our agency channels. I would like to convey to our stakeholders that your company, which is categorized as a domestic systemically important insurer, is fundamentally robust and strategically well poised to cater to the insurance needs of the country, offering the best insurance solutions to our customers while ensuring right pricing of our products. With this, I now hand over to our CFO, Mr. Francis Titus, who will give a presentation on the performance up to Q3 of 2023.
Thank you, Madam. Good evening to all of you all, and welcome once again to the earnings conference call. I will just brief you on the financial results of the company up to Q3 FY24. So we are the largest general insurance company in India with an established brand and expansive multi-channel distribution network and a strong international presence. We are number one in India in terms of net worth, domestic gross direct premium, highest number of offices, and maximum number of claims settled. We are into the 104 years of operations, and as already mentioned by CMD ma'am, the financial strength rating is B++ by AM Best, as well as a long-term issuer credit rating of BBB+ by AM Best, a AAA stable by CRISIL, and this year we have got an additional rating from AM Best, which is an India national scale rating of AAA, which is exceptional and which is the highest in the country. So going forward, we also have issued 30 million policies in FY22-23, and we have a presence in 26 countries through various international offices, agencies and subsidiaries, including a box at Lloyd's, London. We are leaders in segment-wise performance in terms of gross direct premium in fire, marine, engineering, motor, health, as well as aviation. We have a market share of 13.33%, which is the highest in the industry. Coming to the future strategy, we continue to focus on the increasing return on equity by maintaining or increasing the market share and leveraging the benefits of economies of scale driven by growth, rationalization of operating offices, maintaining healthy solvency margin and increasing digital penetration. We also would leverage technology to drive customer satisfaction, profitability and growth. If you look at our business mix, motor OD and TP comprises of around 27%, health and PA 45%, fire 17%, marine 2%, while others are at 10%. If you look at our channel mix, the well-balanced channel mix, direct 32%, broker 33%, agency 26%, dealer 9%, and bancassurance at 1%. Our technical reserves are at 50,551 crores, which shows that we are adequately provided for. Coming to the financial snapshot against GWP of 31,425, we have a profit after tax of 776, and against GWP of 28,440 and profit after tax of 900. Of course, this quarter and as well as the previous quarter, we were impacted by CAT claims. As already mentioned, around 650 crores of CAT claims came in the year. This is why our incurred claim ratio is at 98.07 against 94.7 in the 9 months period last year. Our expenses ratio are almost same as 13.84 compared to 13.91 last year. And our commission ratio is at 8.74 against 7.76 last year. Because of the ICR, the combined ratio is at 120.64 against 116.37 last year. Solvency at 1.72 and ROE at 5.08%. Segment-wise, we have grown in all the lines of business. As already mentioned, we have grown at 10.5 and which is more in motor OD at 24.75 and health at 9.94%. And because of the crop line of business which we have underwritten in the current quarter, there is a increase in the other line of business by 18.83%. ICR, as already mentioned, has gone up from 94.70 for the last 9 months to 98.07, basically mainly because of the CAT losses and some losses, a higher TP ratio and a slightly higher health ratio. As already mentioned, our balance sheet is very strong with a net worth of 20,754, a net worth including fair value at 44,690, investment assets at market value 94,512 crores, and a solvency at 1.72. These were the brief highlights of the financial results of the company for 9 months, December 23. Can you take it forward?
Sagar, we can go for Q&A session now.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Ketan Athavale from Robo Capital. Please go ahead.
Hello. Thank you for the opportunity, sir. I wanted to know what is the combined ratio outlook for FY25 and FY26?
I think that's a little forward-looking statement. That would be a forward-looking statement, and possibly we may not be able to give a forward-looking statement at this point of time. But as I have mentioned in our previous investor meets also, a constant endeavor has been to reduce the combined ratio. The combined ratio, as you know, it comprises of the ICR, the commission ratio, and the management expense ratio. So while the commission ratio and expenses ratio are at at very reasonable figures, and we don't see any much scope for reduction there, but the ICR, yes, we would be looking at reducing, and our focus is to get the combined ratio less than 110%.
Less than 110 is possible by FY25?
Again, it's a forward-looking statement. I said we are always endeavoring towards working towards this target. That is our target in the long run, yes.
And can you mention about ROE also? What do you expect in FY25-26?
These are all forward-looking statements. I think it would be difficult for us to mention that, but I would ask our CFO to take that question.
Yeah, just a ballpark.
Yeah. We always target to have a ROE above 10. So that is what we are aiming at. It's a target.
About 10. Okay. Got it. Yeah. Thank you.
Thank you. Participants, you may press star and 1 to ask a question. A reminder to all the participants, in order to join the question queue, you may press star and 1 on your touchtone phone now. Participants, you may press star and 1 to ask a question. The next question is from the line of Bunty Chawla from IDBI. Please go ahead.
Thank you, ma'am. Just as you have shared that the outlook is to bring below 110%, though in the long term, not in near future, but what are the triggers that should support bringing down this kind of a combined ratio?
Yes, as I mentioned, the commission ratios and expense ratios are at very reasonable figures and probably some of the best figures in the industry. If you see for the 9 months ended, our commission ratio, despite giving added incentives to our sales force under the EOM guidelines issued by IRDA, our commission ratio for 9 months was 8.74% and expense ratio was 13.84%. So combined was about 22%. The ICR is, of course, one factor which we are working extensively on. The 9 months period ICR was 98.07%. Again, this was impacted predominantly due to the catastrophic claims, and we are constantly endeavoring to settle these claims as early as possible and to update the provisions in line with the updated survey reports. We are endeavoring to focus on improving the ICR of our motor portfolio as well as our health portfolio. These are two main components, and a focus on these two prominent portfolios will help the overall ICR to improve as well as the combined ratio to come within the targeted endeavor.
Yes, ma'am, continuing with this, as you said, catastrophic losses of around 650 crores has impacted this. So if I need to understand what was the same number last year 9 months, so that if I equalize this number, then I will get the ICR on a equivalent basis.
So currently the provisions that we have made for these catastrophic perils is about 659 crores, and last year at the same time it was about 202 crores. So there's a good increase of nearly 479 crores on account of this. But like I said, it's a constant endeavor to ensure that the claims are settled fast. As and when we settle the claims, the provisions get released. So hopefully by the end of the fourth quarter, our performance for catastrophic perils will improve.
So ma'am, if I reduce this 650 crores minus 200, so approximately 400 crores. If I adjust this, so your combined ratio should come last year around 116, right? So my query is what are the triggers or the steps or any outlook you can give from 116 to 110%? What are the things we are doing so that it should come down?
See, like I mentioned, the two main portfolios are health and motor, and we are constantly endeavoring to improve the performance here. For instance, if you see in the motor performance, our OD ratio at the end of last year, December, was about, own damage was about 130%. So this is, with a lot of focus on improvement here, this is now improved to about 118%. And our health portfolio also has improved, from about especially the group Mediclaim insurance, it has improved from about 108% to 103%. So these are constant endeavors which we are making, but at the same time, for the motor third-party claim ratio, that has gone up slightly because we have seen that there has not been much increase in the motor TP premium over the last few years. It has been stagnant. And whereas, after the COVID period, the courts are now back in full flow and the awards have increased, and due to inflation, the average, award amounts have also increased. So the TP ratio has, gone up a little bit. We are, again, it's a constant endeavor to ensure that we do a lot of settlement of these third-party claims also, and trying to improve the ratio there also. So these are a little bit of improvements in the motor OD ratio, in the health group ratio, but countered by the third-party claims which have slightly gone up. So that's the overall impact on our ICR.
Okay, ma'am. Lastly, in any segment, do we have taken any price hike or premium hike during this quarter, or any of the segments, fire, marine, motor, any?
So yes, in health we had increased our premium rates after nearly 6 years. I remember mentioning this in the last investor meet also, that our health retail rates had gone up after a break of nearly 6 years. We had increased our rates. So the new policy rates had gone up from 1st of April, and the renewal rates had gone up from 1st of July. Then there was a policy Asha Kiran where the rates had gone up from August onwards. So these are the rates which have gone up as and when the renewal takes place. So obviously that increase would have happened in the last quarter also for these retail policies. Plus, in addition, we have seen an increase in due to the various impacts of the catastrophic perils over the last few years. The rate for STFI, that's the storm, flood, etc. in property, that has gone up by in the range of 15 to 25% depending upon the region. So that has overall impacted the property rates by in the range of 3 to 5%. So yes, we have seen an increase of rates in these two segments.
So just one clarification, you said increase of premium rate, so it was around 3 to 5%. You said, is it right?
In property, yes, overall impact of the increase in HDFI, that has resulted in the net property rates going up by 3 to 5%.
No. On the health side, you said there has been an increase after 6 years of premium rate. So just the rate at which that has been increased.
Increase has happened depending upon the different ages, the different age bands, and that has ranged from 20 to 30%.
20 to 30%. Okay. Yeah. Thank you very much, ma'am.
Welcome.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. Participants, you may press star and 1 to join the question queue. The next question is from the line of Shreya Shivani from CLSA. Please go ahead.
Yes, thank you for the opportunity. I have two questions. First is on the loss ratio for the health segment. Can you help us break up the loss ratio in the health segment between retail policies and group policies, specifically the employer-employee segment? And my second question is on the solvency ratio. So the solvency ratio for the 9 months came in at 1.72. What is our internal target of where we want to keep it or where we are comfortable? I know the regulatory requirement is 1.5 times. And is my understanding correct that the higher claims that must have come through is what has dragged the solvency, because the growth has roughly been only 10-11%, right? So is that understanding correct?
Yeah, I'll answer your second question first. Yeah, you're right. The impact on the solvency has been predominantly due to these increases in the catastrophic claims. And our internal guidelines, and we want to take the solvency at anything above 2. That is our endeavor and our target. So that was the second question. Regarding the first question, your question on the health insurance, you wanted to know the ICR of the employer-employee relationship. That was called the group Mediclaim. That was last year 108% at this point of time, 31st December 22. It is now at the end of 31st December 23, it has improved to 103%.
And retail segment, which is your indemnity retail policies.
Yeah, that we are seeing the ICR at about 98%.
Okay, that is on 8%. And then just one follow-up on the solvency ratio. So you will be raising capital or any plans, because you're clearly under 2, like significantly under 2, which is your internal target.
No, we would not be raising capital. If you see, our net worth is at one second. Our net worth is at 19,000. It's at 20,754, but on fair value, it is 44,690. So it's nearly 2.5 times. So the fair value change is not counted for solvency, but our actual net worth, including the fair value change, is 44,690.
Got it, ma'am. This answers all my questions. Thank you so much.
Welcome.
Thank you. Participants, you may press star and 1 to join the question queue. Participants, you may press star and 1 to ask a question. A reminder to all the participants that you may press star and 1 on your touchtone phone to ask a question. Participants, you may press star and 1 to ask a question. The next question is from the line of Dev from Haitong. Please go ahead.
Hi, am I audible?
Yeah, you are.
Okay. My question was on the lines of in the commercial line of business, mainly fire and marine. The growth has not been coming on a 9-month or over 9-month period. You've also mentioned that was I guess that was probably because of the prudence that you have got into the system of underwriting and bringing in profitability. So is that the only reason why the growth has been weak, somewhat weak in the commercial lines of business? And is there anything that we intend to undertake to improve this kind of growth in these lines at least?
See, the growth in the fire segment has been about 6.26%, and the growth in the engineering segment, it is in the range of about 15%. There has been a lot of investment in the infrastructure, so we are seeing a lot of increase in the projects policies coming, which fall under our engineering policy. So we are seeing many large projects, many new projects for which we are issuing engineering policies. As well as fire, yes, we have been quite prudent in underwriting these the policies, and we are focusing on growing in the right segments. So yes, we have taken a conscious decision in some areas which have been continuously loss making for many years. So we have taken that conscious decision, possibly not to renew, or to renew at harder terms which the client may not have accepted. But yes, there is a lot of competition also in these segments. So yes, in fire we have seen a growth of 6.26%. It has grown from 4,900 crores to about 5,264. Engineering, our growth has also been there of 1 second. In engineering, we have seen a growth of from about 700 crores to 772 crores.
Okay. Got it. That's helpful. Thank you.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of R.K. Khandelwal, who's an individual investor. Please go ahead.
So you have substantial investment in your portfolio where market value have increased substantially. Do you have any plan to dispose of some of the shares to earn long-term capital gain and distribute among the shareholders?
I will request my CFO, Mr. Titus, to answer this question.
Yeah. As you said, we have a lot of fair value reserve account, but we will use it judiciously. It will be as and when the requirement is there, only that time only we will be, monetizing those shares. So we cannot be, selling it off all at one and, giving it to the shareholders at one instance.
No, at present market value is high, and since your portfolio has increased substantially 2-3 times, and you have a substantial gain. Therefore, I say part of the gain can be used.
Yeah, that we are already doing it. We are already doing that to that extent required. So That is already being done. That is why also we have the profits during the period. Also, there are underwriting losses. No?
You have some plan in future also in the coming fourth quarter?
Yes. We have the targets, internal targets. So that has been taken care.
Okay.
Mr. Khandelwal, do you have any other questions?
No, it's all right.
Thank you. Participants, you may press star and 1 to ask a question. To join the question queue, participants, you may press star and 1. As there are no further questions from the participants, I would now like to hand the conference over to Ms. Neerja Kapoor, Chairman and Managing Director of the New India Assurance, for closing remarks.
Thank you, Sagar, and thank you, Aryan and your team from Veritas Reputation for organizing this conference call. I would like to thank all the participants again for attending our call, taking time out from their busy schedules. If you have any further queries, I will request all of you to please get in touch with us. We would be happy to address them all. Thank you once again.
Thank you. On behalf of the New India Assurance Company Limited, we conclude this conference. Thank you for joining us. You may now disconnect your lines.